Professor Liu about the latest development. What do you make of the real meaning behind this new regulation about Chinese overseas investment?
I think that there's a general fear among the policymakers over two major issues. Number one, there has been a dramatic reduction of the Chinese foreign exchange reserve, which is really made uncomfortable for the policymakers. Number two is that a number of Chinese investment overseas has caused adverse impact in terms of the environmental issue, in terms of a labor issue, and also those businesses that are not really related with the Chinese development strategy. So that's really provokes the government to take a very radical action actually against such sort of behavior.
Well, that's the Chinese perspective. What about from the other direction? Let's go to Mr. Dollar from the United States. Mr. Dollar, of course, has been serving in the World Bank several years in China, knows the Chinese situation. Mr. Dollar, what do you make of the so-called ban, restrict, and encourage different levels of policy in terms of foreign investment?
So I think the Chinese government has two objectives. First, they're trying to limit the overall outflow of capital from China. They want some capital outflow, but they don't want it to be too big. They don't want it to push down the reserves and push down the currency. And for the last 6 months or so, the reserves have been pretty stable and the currency's been stable. The second thing they're trying to do is manage the composition of the outflows. So they don't want Chinese firms and households to be buying real estate or sports clubs or hotels. They want to direct the capital outflow into high-tech sectors, natural resources, and the Belt and Road Initiative.
All right. Well, 2016 was a record year of overseas spending for China, but in the first half of this year, Chinese investment in other countries plunged already as a result of some previous policies. 46% according to the Chinese Commerce Ministry. The drop was even sharper, more than 80% in the industries the government is now targeting, for example, real estate, hotels, entertainment, and also movie industries, and etc. So, Professor Bastian, the question is whether the Chinese investment are going to find enough and good targets when it comes to the other fields, the targets that's likely to have their money back efficiently and also benefit them in the long term.
Well, I see no reason why not. I think the government action, government announcement makes a lot of sense. Chinese industries going international is still in a fairly early stage, and overseas acquisitions, cross-cultural issues, 6 out of 10 fail for very obvious reasons. So I think with government help, I think that's what we're going to see. The government are going to help Chinese companies target the right sectors, so obviously energy, clean energy, and I see no reason why that can't work very, very well. Often the leaders of these Chinese companies that have gone overseas quite spectacularly have gone on what is really perhaps no more than a shopping spree, and that does concern the government. It's not just about capital outflow. So I think government support will help Chinese companies target sustainable growth in a very strategic way, and not look for quick kills and reckless acquisitions, which have happened.
I see. Mr. Dollar, I think one of the things we really need to mention is what about those companies that have been investing heavily overseas, many of them using huge bucks to buy properties and stuff. But the question is, they've been borrowing money from the Chinese banks. So now, if they are not encouraged, even banned from investing overseas, but they have already borrowed, so what's going to happen with their debt to the Chinese banks? Meanwhile, if there were agreements between these companies and the foreign companies, if they cannot continue to invest, that means they're going to destroy their contract. As a result, they need to pay back and compensate the other party. So what is likely to be the side effects of these new regulations?
Well, I think we have to wait and see about the detailed implementation. I hope they don't try to walk back some of the agreements that have already been made. Once the agreements are in place, you have cases where Chinese companies have made acquisitions overseas, if the government forces them to sell, they're probably going to lose money, and that's not a particularly smart strategy. I do think you point to an important issue that a lot of these Chinese companies have borrowed heavily to make the acquisitions. Often they're borrowing short term to buy assets that are inherently long term. So there definitely are risks in the financial system, and it makes sense to control those risks. But I think you do that through financial regulation, not by trying to intervene in these individual transactions.
Professor Liu, and what about the other companies? I mean, some of the specific company was being mentioned once and again in international media reports when it comes to, what exactly these new regulations are targeting. But actually, a lot of Chinese companies, individuals as well, are investing overseas. There's a lot of cash flow here in China, and it's going everywhere in the world. So, Professor Liu, what about those people, those companies, those individuals?
Well, basically, there are two categories of overseas investment from China. The first category would be strategy investment or policy-driven investment, and those are really targeting the resources that are really needed, particularly those energy part, and also the green part from basically the United States and Brazil. And the other would be the commercial investment overseas, and most of the commercial investment overseas are really driven by private firms or even individuals who really join into a equity type of entity. So I think now this Chinese policy need really to make a difference between two of them. For those state-owned firms who manage those the big strategic merger and acquisition, so they are really under tougher guideline. But for those individuals and private firms, and I do really think that the policymakers will have to give them a more lenient way, because it's their money and they are making their own independent decisions.
Is that a good idea, Mr. Dollar?
I guess I'm skeptical that the Chinese government is going to be able to manage this very efficiently. When China started going out, one of the first things the government did is encourage Chinese firms to buy natural resources. Iron mine in Australia, copper in different locations, oil and gas. A lot of that's turned out badly because prices have fallen for those commodities. So I'm skeptical the government is going to be very effective at directing this. I think it makes more sense to let private investors go out and find their investments. And there will be some mistakes in the short run. We went through this with Japan when it was first coming out. Japanese companies made some bad investments. There's inevitably a learning experience, but I'm skeptical that the government can prevent some of these problems from developing.
But Mr. Dollar, one of the arguments for these kind of policies is that we cannot hit the same wall that the others have already hit decades ago, for example, Japan. And when you look at the scale of this economy and the debt is likely to pile up as a result of this borrowing from companies, that's be horrendous, some would argue, Mr. Dollar.
Yeah, but I would approach it, though, from the point of view of macroeconomic policy. So I respect the fact that China is trying to limit the overall capital outflow. I don't think they should just open up the capital account completely. I think that would be quite disastrous, frankly. So limiting the overall capital outflow makes sense, and that's probably best done through interest rates and some of the capital controls that are in place. And I think financial regulation is critical. This issue of firms borrowing short-term, buying long-term assets, that's very risky. Whether they're doing it in China or they're doing it internationally, that's very risky. So I would go after the financial risks. I would keep the capital account managed, but I'm skeptical that trying to control the individual transactions is going to work well for China.
All right, Professor Bastian, your view here.
Obviously, the scale of everything when we're talking about China does prevent the government from being too hands-on, but I think they'll be very selective, and I think they will publicize their role. So I think that they will have an influence. And I think the point that was made about Japan and MITI, the Ministry of International Trade and Industry, I think what the Chinese government are probably going to do is follow the role that MITI played in helping Japanese companies not just expand internationally, but expand in a strategic way, target certain sectors, obviously electronics, consumer electronics, engineering, and build a base internationally, a step-by-step market penetration plan. So I think it's going to be a very nurturing, facilitating role, and I think that the influence could be quite significant. So I welcome this announcement.
Mr. Liu, Professor Liu, does it make sense?
Well, absolutely. I think now the government really need to play a tougher hand in dealing with the emergency, which is really transitional. But the soft hand part would be, to give more of the information, to offer more of the guidance for capacity building for those both state-owned firms and private firms. And also the government can also weave a more macro type of environment by building and updating more of the investment, the protection treaty, double taxation issue, so that so that they can really make a more wise and more informed decision instead of repeating the mistake that Japanese made 20 years ago.
Well, different from what the Japanese did decades ago is now in this regulation, there's also one part that is dealing with so-called encouraging industries and also enterprises, individuals to invest. That is about the Belt and Road Initiative. Namely, it is an initiative coming originally from China, and it's talking about countries in Southeast Asia and also in Eurasian area, going to Europe. Also Africa could be part of it, even some talking about Latin America. The number of countries involved is not yet clear at this point. It could be very much expanded. So Professor Bastian, do you think this kind of long-term investment, which is infrastructure, what it's all about, will be able to attractive enough for investors, particularly not just as the state-owned, because they need to follow what the government guidelines are, but also private ones, individuals as well?
Yeah, yes, I do. I think the government, what we'll see from the central government, the Chinese central government, is that they will be encouraging private investment and private sector entrepreneurs. That's very much a central plank in their strategy. So I think they will be targeting those. And when it comes to encouragement, I think they will be helping them with finance as well. So supportive finance is a very, very important role that I think the government will now play a more active part in. So I think they will look for a balance between public and private, but certainly be looking more to the private sector. And again, I think that's a very, very welcome move. And the state-owned enterprises will recede in their importance.
But what about that infrastructure investment, Mr. Dollar? Of course, the United States is not part of the Belt and Road Initiative, not AIIB either. But when you think about investment in infrastructure, what kind of incentive you have to give to enterprises and business community in order to do that? Will this time be enough or encouraging
Frankly,
enough?
Well, I think, Tianwei, it's very hard to get the private sector to invest in some of these infrastructure sectors, particularly in developing countries where there are a lot of risks. Right now, China is providing about $70 to $80 billion a year of infrastructure financing, and that's mostly going to transport and power. There's a little bit of potential for private investment in power, but in developing countries, it's been very hard. So mostly this is financed by China's state policy banks, China Development Bank and China Exim. And I think you made an important point that it's really the whole world. So far, there's been more Chinese financing in Africa than there has been along the Belt and Road. I guess you could call Africa part of the Belt and Road if you want, but then really you're saying it's the whole world. So I see it as a global phenomenon that China's financing infrastructure, and it's mostly welcome, and it's mostly coming from the government sector. I think the Chinese private investment is primarily going to the United States and Europe, and so far Chinese private sector has not been that interested in the Belt and Road.
What about that, Professor Liu? The division, it seems, Mr. Dollar pointed out.
Well, I do agree with Mr. Dollar because the you really need to think of what is the really strategic goal of the government guideline. One is really to prevent the capital outflow, and the other is really to prevent more of the trouble the Chinese companies would engage in overseas investment. But now for the Belt and Road, it's more, we add another consideration, which is really geopolitical consideration. So those private companies, they are worried over two things. Number one, do they have a say if they join the big bandwagon led by state-owned firms? Number two is that, can I wait until 10 years later to really recoup my money? So this is something entirely different. And plus, now the world is highly interconnected. So even if I invested in Canada or in part of Europe, my business may be related with part of the Belt and Road countries. So therefore, arbitrary decision by policymakers can really twist the entire picture and also make the individual decision very ineffective.
One of the things that we haven't mentioned is, gentlemen, what about the so-called supply side, the structural reform of the Chinese economy? That has been said for quite some time. If money is not going to the hotels, not going to the sports clubs, not necessarily purchasing, the movie chains, is it going to be investing in the areas where there's likely to be, should be, more supply to the Chinese consumers, as we are seeing today? Professor Liu, briefly.
Well, I think we need really to give more leeway to those individual companies. For example, I know of a company who bought a sports team, but they use the sports team to do advertising locally because they have a very strong local market base for those to build loyalty among those consumers, which are really good enough. So therefore, we really need to give more detailed calculation over what is really strategic investment. It's not really only buying the top-notch technology or buying resources, but all business along the entire value chain, they are also very much connected. So therefore, a blanket policy won't really work to the reality.
Mr. Dollar, very briefly from you, final words.
Great question, Tianwei. I do think that part of the pressure for capital outflow from China is that there's a lot of excess capacity in the old sectors in China, and it would help to open up more of the economy for new sectors, social media, entertainment, financial services, create new investment opportunities. As you say, if they don't want the capital to go buy sports clubs in Europe, then it'd be good to have more opportunities in China for private investment.
I see. And Professor Bastian, final word as well.
Well, I think I echo the sentiments that have been made. I think that the government will make it more attractive for private investment and private entrepreneurs to invest in these strategic industries, and that can only be a good thing for a more sustainable growth model for China.